Hi everyone. In this video, I would like to explain you about accounting conventions. Myself, Dr. Pradeep Reddy, Associate Professor, School of Management, Sage University, Bhopal. So, what are accounting conventions? So, what are accounting conventions? An accounting convention refers to common practices which are universally followed in recording and presenting accounting information of the business entity, and conventions denote customs or traditions or usages which are in use since long. To be clear, these are nothing but unwritten laws. There is no proof that you have to follow. There is no rule that you have to follow this. And if you don't follow this, you will be under crime. It is not like that. For example, if you are going to a party, you will be wearing party wear dresses. And there is no rule that you have to wear party wear dress. You can go by normal itself. But it's a tradition. It's a custom that if there is a party, we will be wearing a party dress. So here also, accounting conventions are those concepts wherein we are having some customs and traditions we have to use to follow them. We should not violate them. So the accountants have to adopt the usage or customs which are used as a guide in the preparation of accounting reports and statements. So these conventions are also known as doctrine. Why? Because violating these will not cause any effect to the organization. But if we follow these will bring a very goodwill to the organization. And let us see what are these accounting conventions. So the first and foremost is consistency, full disclosure, materiality, and conservatism. So let us see them one by one. What is conservatism? What is a convention of consistency? Is the convention of consistency means that same accounting principles should be used for preparing financial statements year after year. That is, a meaningful conclusion can be drawn from financial statements of the same enterprise when there is comparison between them over a period of time. Because every year when we are preparing these financial statements, we can know that how the business is, how the liabilities are developing, and how the assets are to be developed. Because when we increase the assets, only will be having the repayable capacity of liabilities. So, but this can be possible only when accounting policies and practices followed by the enterprise are uniform and consistent over a period of time. So if different accounting procedures and practices are used for preparing financial statements of different years, then the result will not be comparable. Because if you are not filing the financial statements properly, it doesn't have any idea about what is to be compared and from which year we have to compare this. So consistency means we have to be prepare these financial statements year after year. There should be some continuity. So that is consistency. And the second one is the convention of full disclosure. So convention of full disclosure requires that all material and relevant facts concerning financial statements should be fully disclosed. And financial full disclosure means that there should be full, fair, and adequate disclosure of accounting information. We should not hide any information. And adequate means sufficient set of information to be disclosed. Fair indicates an equitable treatment of users. Full refers to complete and detailed presentation of information, and thus the convention of full disclosure suggests that every financial statement should fully disclose all relevant information. And that let us relate it to the business. That is, the business provides financial information to all interested parties like investors, lenders, creditors, shareholders, etc. And the shareholder would like to know profitability of the firm, while the creditor would like to know solvency of the firm business. In the same way, other parties would be interested in the financial information according to their requirements. And this is possible if financial statement discloses all relevant information in full, fair, and adequate manner. So, full disclosure means that is we have to disclose all the materiality facts because there are many individuals or the stakeholders who are dependent on this information, like investors, lenders, creditors, shareholders, even the employees also. So that is convention of full disclosure. And the next one is convention of materiality. So what is convention of materiality is, the convention of materiality states that to make financial statements meaningful, only material fact, that is important and relevant information, should be supplied to the users of accounting information. The question that arises here is, what is a material fact? So the material fact depends on its nature and the amount involved. So material fact means the information of which will influence the decision of its importance. Because unless and until if it doesn't disclose it clearly and legibly and viable to the information to it, it will not be treated as a full and clear extent. The parties will be getting a doubt, content of doubt, whether this is material fact or not, or something has been hidden. What is that? So that should not be done. So convention of materiality means that you should bring a proof to it. When the financial statements are prepared, there should be some meaningful to it. It should be meaningful. And the next one is the convention of conservatism. So this conservatism is based on the principle that anticipate no profit, but provide for all possible losses. That means it provides guidance for recording transactions in the books of accounts, and it is based on the policy of playing safe in regard to showing profit. Play safe. That is, even in the game also, we have to play safe because we have to win. We have to win the game. So here also, we have to get the profit, win the anticipation, think that we will be getting losses and work for it, but finally we will be getting profit. So that is play safe. The main objective of this convention is to show minimum profit. So profit should not be overstated, and if profit shows more than actual, it may lead to distribution of dividend out of capital, and this is not a fair policy, and it will lead to the reduction in the capital of the enterprise. And thus, this convention clearly states that profit should not be recorded until it is realized. But if the business anticipates any loss in the near future, provision should be made in the books of accounts policy. So, for example, valuing closing stock at cost or market price, whichever is lower, creating provision for doubtful debts, discount on debtors, writing off intangible assets like goodwill, patent, etc. So the convention of conservatism is a very useful tool in situation of uncertainty and doubts. And thank you everyone for patience. And if you have any doubt with relating to this, please write a comment. Thank you everyone.